Volatility is the fluctuation of the market price of a stock. Events taking place around the world have a direct impact on the opinion of investors, which in turn creates volatility. It is in the short term that volatility can manifest itself especially strongly, which is why it is so important to focus on the long term. Having invested money even in a great company at a bargain price, stocks can still lose in value, and no one will know when the situation will change. However, it is worth noting that the risk of investing in stocks has nothing to do with volatility, although for some reason a global theory says the opposite. The risk depends on the state of the business in which you invested the money. Why volatility is really not a risk will help to figure out a good example of buying and renting real estate. When you evaluate a property for $1 million, you expect to receive $100,000 in profit per year or 10% of your investment. Having made a purchase and renting out the property, you begin to receive the expected $100,000 a year. But it becomes known that its estimated value fell by 20%, for no good reason. What will an adequate investor do? Nothing. He will also successfully continue to lease property and receive his $100,000. Because by investing money in this real estate, the investor focused on generating income, and not on its subsequent sale at a higher price. Investing in the hope that you can sell something at a higher price is a mistake, because there may not be such a buyer. In the situation considered, with investing in real estate, it makes no sense to sell it, because there are no objective moments that threaten income generation in the future. The exact same situation with stocks of companies. It is necessary to find a quality business that is not in danger, and which brings a steady income, and then invest in it and ignore the price. In fact, volatility is an opportunity. Suppose the price at which you bought a stock was $100, and the profit on it was $10, that is, a 10% return. As time passed, the price fell to $50. Paying that, you will also receive $10 profit, but the yield will not be 10%, but 20%. That is, having bought even more shares, but at a new price, you are investing money with higher returns. Volatility is a normal feature of the stock market. This must be accepted and used for their own purposes. Over the past half-century, a 50% drop in prices has occurred many times. And most importantly, this can happen at any time. Who sets stock prices? Investors. It is they who move it, then in one direction, then in the other. And to be more precise, the stock price is formed under the influence of supply and demand. There are many reasons that affect supply and demand, which ultimately leads to an increase or decrease in the price of both the shares of a particular company and the shares of the industry and the market as a whole. It is impossible to predict when and what specific events will force investors to buy or sell shares. When many investors want to get rid of stocks as soon as possible, and the number of people who want to buy them at the current market price is minimal, the first to lower the sale price is to find those who want to buy. All this leads to lower stock prices. What could motivate investors to sell? Poor performance of the company or sector as a whole, unfulfilled forecasts of analysts, general pessimism, economic crisis, increase in interest rates, debts, gossip. And when many investors are striving at a fast pace to buy more stocks, and those who want to sell them at the current market price at a minimum, the first to increase the purchase price in order to find those who want to sell. This is driving stock prices to rise. This may occur for the following reasons: improving business results, general optimism, fulfillment or overfulfillment of analysts' forecasts, decrease in interest rates. As you can see, among all the above reasons, both fundamental and psychological points can be noted. The only factor that really matters for rising or falling prices in the long run is the condition and success of the business.